Welcome to vTalkInsight, Allocator's Lens Daily from March 11th, 2026. Cross-asset positioning today is caught between an intense Middle East energy shock, record artificial intelligence investment in equities, and a steady buildup of credit and policy tail risks. Oil supply disruptions, elevated but easing volatility, and a higher stated probability of a major market break are forcing allocators to rethink diversification and the balance between growth exposure and protection. Let's start with equities, where that tension is most visible. In equities, the dominant narrative is a clash between powerful optimism around productivity and artificial intelligence, and a rising probability of macro and geopolitical shocks. On the positive side, markets are putting more weight on efficiency gains than on traditional data, such as monthly payrolls, helped by a major capital spending cycle from the largest technology firms that still looks more disciplined than the late 1990s. That growth story, plus solid recent earnings, keeps the main United States equity index on a rich multiple near 22 times earnings, and some long-term projections still point to substantial upside this decade. At the same time, the probability assigned to a severe market break this year has been lifted to roughly 35%, with a 10 to 15% correction seen as a very plausible path, even without a full crisis. Recent price action underlines that fragility. We have seen sharp down days followed by brisk rebounds, yet headline equity moves remain relatively contained, and the volatility index has slipped back from extreme readings in the mid-30s to the mid-20s, signaling that risk appetite is bruised but not broken. Beneath the surface, dispersion is high. Large technology and artificial intelligence beneficiaries continue to attract capital, supported by strong semiconductor demand and very large, market-friendly bond deals to fund data center build-outs, even when that means periods of negative free cash flow. By contrast, sectors most exposed to higher energy and shipping costs, such as airlines, banks, materials, and consumer durables, are being punished, while even defensive areas like staples and healthcare have lagged. Weak results from discretionary retailers and evidence of softer middle income spending suggest the consumer pillar is less solid than headline growth would imply. The energy shock is the key swing factor for equity scenarios from here. History shows that major oil spikes often precede recessions and bear markets, and persistent crude prices above $90 are estimated to shave around half a percentage point from global growth while adding roughly 1 percentage point to inflation. Equity markets appear more sensitive to sustained increases in longer-dated oil prices than to short-lived front-month spikes, because it is the duration of higher input costs that ultimately drives earnings downgrades and pressure on valuation multiples. There are offsets. The United States is now far less energy-intensive than in the 1970s and is a major oil and gas producer, which reduces classic stagflation risk compared with past shocks. For allocators, the crucial questions are how long the Gulf disruptions last, whether artificial intelligence-driven productivity can keep earnings growing through higher input costs, and how much of the growing correction risk is already embedded in current prices. That same energy and inflation debate is now front and center in rates. In rates, markets are wrestling with an inflation shock that has yet to morph into a clear growth scare. Elevated energy prices and shipping disruptions are feeding through to gasoline and electricity bills, and many now expect central banks, including the Federal Reserve, to delay rate cuts. The Fed is seen as constrained by stubborn inflation pressures from fuel costs, even as some labor and small business data soften, raising the risk of what looks like policy paralysis. In Europe, where economies are more dependent on imported energy, front-end yields appear especially sensitive to further oil shocks and could reprice higher if inflation proves sticky. At the same time, long-dated yields have been under pressure not just from the inflation narrative, but also from heavy supply, including record-sized corporate bond offerings that absorb demand which might otherwise have gone into government paper. Despite these moves, current stress is still viewed more as an inflation shock than as the start of a systemic liquidity crisis. Central banks are better equipped with swap lines and repo facilities, and market functioning has remained orderly even through 5 standard deviation style swings across assets. One key complication for allocators is that bond and equity prices have been falling together at times, reducing the diversification benefit of owning duration. If the oil shock persists and begins to damage growth more visibly, the narrative could flip with recession fears pulling long-end yields lower as markets anticipate a more dovish stance down the line. For now, though, the balance of evidence points to stickier inflation, delayed easing cycles, and a more complex role for government bonds as both a hedge and a potential source of volatility, setting the stage for growing tension between public and private credit markets. Credit markets tell a two-tier story. On the surface, conditions look robust. Investment-grade corporate spreads remain historically tight, under 100 basis points in many cases, and capital markets are open, with refinancing dominating issuance. High-profile issuers are pressing ahead with record-sized multi-currency bond deals, and early indications suggest strong demand, especially for large, stable technology names. Insurance companies have navigated the shift from very low to higher interest rates without obvious asset and liability mismatches, and their stocks have outperformed, reinforcing the sense that the core of the system is sound. There is also evidence that high-yield bonds are regaining favor over leveraged loan structures for some buyouts, reflecting the appeal of simpler capital structures and the potential for better ratings over time. Beneath that calm surface, however, stress is building at the private end of the spectrum. Concerns are rising about weaker underwriting standards and opaque exposures in private credit, where some managers are facing increased redemption requests and struggling to meet them, pointing to emerging liquidity strains. Commentary highlights leveraged loans and private credit vehicles as the most likely flashpoints if the macro backdrop deteriorates, especially in a world of higher energy costs, uneven consumer demand, and weaker bank share performance that hints at tighter lending conditions. Individual names illustrate how quickly sentiment can shift. Aggressive artificial intelligence-related capital spending has already pushed up funding costs for at least one large technology and software vendor, with wider credit spreads reflecting a market that is no longer willing to ignore leverage and concentration risks. For allocators, the key watch points are default and recovery trends in these private and leveraged segments, and whether today's tight public spreads can persist if the oil shock extends. In foreign exchange, the United States dollar remains the short-term safe haven of choice during geopolitical stress, even as longer-term debates around diversification away from the dollar gather pace. Current commentary suggests that over the next several years, a more diversified reserve and investment mix could become advantageous if the dollar's exceptional strength slowly wanes, especially as global economic fragmentation and regional blocs in Asia gain importance. For now, though, a firm dollar amplifies the energy shock for oil importing regions, tightening financial conditions for parts of Europe and Asia that also face higher local fuel prices and more direct inflation pass-through than the United States. Japan sits at a critical intersection of the rates and foreign exchange stories. International investors are returning to its bond market as yields move closer to those in Europe, while domestic demand is restrained by regulation and demographics. The Bank of Japan is expected by many to raise rates in April and to deliver 2 more hikes by next spring, but there is a clear risk of delay. If tightening is postponed while oil and liquefied natural gas prices remain high, the yen could weaken further and Japan's trade balance could deteriorate, undermining some of the appeal of those higher yields. Against this backdrop, central bank liquidity tools and swap lines help to limit outright funding stress. But currency moves remain an important transmission channel for the energy shock into regional growth and inflation, linking directly into the commodity complex. Commodities, and oil in particular, remain the fulcrum of the current regime debate. The effective closure of the Strait of Hormuz has trapped hundreds of vessels and halted Gulf traffic, putting at risk around 1/5 of global oil and gas flows and forcing insurers to demand extraordinarily high levels of coverage. On top of that, major producers in the region have cut output by roughly 6% of global supply, and a very large refinery in the Gulf has been shut after a drone strike, tightening refined product markets and driving an outsized spike in jet fuel prices. The result is unprecedented volatility. Brent has swung by more than $30 within a single session, and recent days have seen 8% moves lower after political comments hinting at possible de-escalation, even though the physical disruptions and shipping bottlenecks remain unresolved. Options markets indicate that a sizable risk premium is embedded in oil, with prices several dollars above what past relationships would suggest, yet views on the fundamental tightness of supply are divided. Some argue that if logistics and security issues can be addressed, global oil availability is still ample, making this mostly a temporary disruption and inventory management story. Others, including regional producers, warn that prolonged conflict and blocked shipping lanes could create a genuine shortage that cannot be offset by reserve releases or export restrictions, particularly for Asian buyers already facing acute stress. If crude were to remain above $90 for months, estimates point to a meaningful drag on global growth and about a 1 percentage point boost to inflation, a combination that could push the macro narrative from inflation scare toward full stagflation and significantly widen credit spreads. Gold rounds out the commodity picture. Despite recent underperformance, several observers expect it to trend higher over the coming years as demand for diversification and inflation protection builds alongside persistent geopolitical risks. Some projections are highly ambitious, with price targets far above current levels over this decade, reflecting a belief that gold will benefit both from hedging demand and from a gradual move toward a more multipolar currency system. Whether those forecasts are realized or not, the combination of an elevated oil risk premium, uncertain policy responses, and renewed interest in traditional safe havens underlines how central the commodity complex has become for cross-asset allocation, and it sets the stage for a more volatile, scenario-driven environment across portfolios. Stepping back, today's cross-asset picture is defined by a tug-of-war between strong structural growth stories and acute event-driven risks. Equities remain supported by artificial intelligence-driven productivity gains and solid earnings, but valuations are high and the stated probability of sizable drawdown has risen, especially if the oil shock proves persistent. Rates markets are being forced to reprice a slower and shallower easing cycle, even as bonds struggle to provide the diversification they once did, while credit shows a striking contrast between tight public spreads and growing vulnerability in private and leveraged segments. In foreign exchange, a firm dollar and uncertain Japanese policy amplify the energy shock for importers, and commodities sit at the center, with Middle East supply disruptions and large risk premia in oil and renewed interest in gold shaping the macro path. For allocators, the key watch points are the duration of Gulf disruptions, the evolution of inflation data relative to central bank reaction functions, and early signs of stress in private credit and energy-exposed sectors. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.